Happy Friday, everyone. Welcome to 2022. Rich Swerbinsky with the Mortgage Collaborative here with the Rundown with Rob and Rich. We just started broadcasting live and we will get started momentarily here. So Rob, you said you had some surprise this week.
Really? If I told you what it was, would that spoil it?
Okay. All right. So you're going to wait to unveil it.
Well, I could do it now while we're just, chatting away.
Okay.
So I don't know if you get a lot of emails and questions, Rich, about this show, but I know I do. And I actually, I actually respond to the letters from listeners who have questions about the show, and they mostly have to do with you. So the
Viewer mail. It's a new evolution.
Yeah, listener mail. The first one, I think that people may be intimidated by you, or perhaps too shy to write to you directly. So they think that I guess I'm more approachable. Or maybe they don't want their identity revealed to you. I don't know. The first one was, Rob, throughout 2021, Rich rode you like a rented mule and treated you like a redheaded stepchild. What gives? Are you going to give him a piece of your mind in 2022? So I wrote back, dear whoever, Rich continually makes it clear that he calls the shots. I serve at the pleasure of Mr. Swerbinsky. And then I went on from there. But I basically said that he needed to write to you. The second letter was, Rob, we have an office pool and active wagering during the Rich and Rob sessions about how many times Rich brings up the word inventory and asks when price appreciation is going to stop. Any advice on the over and under? So I replied, dear Better, these topics are certainly in the mainstream press. I said, write to Rich directly if you have concerns about the content or want to bring up your own issues. That's what I said. I thought that was pretty adult of me. And then the third one I printed out was, Rob, Rich seems very content broadcasting from his new home week after week, whereas you roam around like you're trying to avoid a debt collector. Why can't you be more like Rich? And so I replied, there are a lot of people out there who want to be like Rich, but there's only one. Although internet sleuthing of the name shows an inmate at Joliet serving 10 years for attempted vehicular manslaughter. Rich, do you know anything about the guy with your name?
I don't, and I'm going to direct all future questions to my legal counsel, though.
I'm sure it's somebody else. Anyway, so there you go. I think listeners should write directly to you rather than put me in the middle of the correspondence like that.
Oh boy. Well, I would say,
what would you say, Rich?
I don't know what I would say. You probably dole out more jokes towards me than I jokes I dole out towards you. No.
Well, I didn't print the letter that said Rich is very humorless. So I didn't think you wanted to go there, but maybe next time.
All right. Well, viewer mail, a new and unexpected addition to the Rundown with Rob and Rich. So, but let's go ahead and get into it. And as always, any comments, questions, thoughts, anything, feel free to pump them in the chat or the Q&A, and we will incorporate them into the show unless they're horrible or meaningless. Rob, we got to start with the FHFA LLPA increases. We had some members belly aching. There's a bigger picture here, according to things I'm hearing. Just increased LLPAs for second homes, conforming high loan limit stuff the agencies really don't want anyway. Stuff that there is a strong demand in the private and increasing private market for. A poor tender right to LLPA upcoming decreases most likely in areas that can help, maybe the people more on the fringes of home ownership, right?
I agree 100%. The easiest way to really shut off business is change your pricing, or make your service really bad, or eliminate the product entirely, right? Product, price, service. So when an agency, or when a lender, or when a broker, or when, your local convenience store changes their price or does away with a product, uh, flaming hot nachos, they can either raise the price or they can just not carry the product. Well, in this case, the agency decided to adjust the price, and the industry will follow. And really, when you look at the segment of business that they're impacting, the, coast to coast, if you look at California, Oregon, Washington, Arizona to some extent, that's there's a lot of high balance there. There's a lot of jumbo product that's done there. You have to go a long way across the nation until you get into another jumbo / high balance market. And that's primarily along the Atlantic seaboard in Florida, Texas to some extent. So Fannie Mae and Freddie Mac, the FHFA, have said, okay, well, this isn't our primary, target audience here. So let's tweak the pricing there a little bit. The private label security market will absorb some of this. Some of the loans will go into the jumbo market, and I mentioned that in my commentary. So some of the loans will go that way. Some will go into non-QM. And you're right. I'm not going to sit here and predict that FHFA and Sandra Thompson will come out and say, oh, we're going to lower our loan level price adjustments for the bread and butter of the nation, loan amounts from 100 to 300,000 and so forth. But yeah, that's a pretty good thought. But yeah, I don't think you could hear some belly aching out there, mostly from lenders or mortgage loan originators along the coast. But for the most part, given the mail that I received after the change, it was kind of a shrug. It wasn't a big deal.
Yeah. And I think the tea leaves and things we've heard from Sandra Thompson point to, a comprehensive review of LLPAs in general. I hadn't realized how long it had been since there had been any adjustments to them, and things change. We know how quick the industry changed. Housing in America changes. So I thought that was smart. And I made a comment on LinkedIn right when it came out, really commending Sandra and FHFA for doing this. Because, when Calabria put the 6% cap in, people freaked out, and for good reason, because there's a lot of non-owner occupied lending going on right now, more than in the past. And they were using percentages from the past to get to that number. And we all kind of said, why don't you just adjust the pricing? It'd be much easier than putting these per lender limits in place. So yeah, I think a much smarter way to approach it. It helps mitigate a little bit of the GSE's risk. They're clearly going to be taking more risk at the lower end of the credit spectrum. A way to bring in some extra delivery fee income that they can use to justify and offset likely reductions to come that can help President Biden pursue some of his home ownership agendas. So,
right. I had an opportunity to meet Sandra Thompson at the San Diego MBA National, an in-person conference, as is coming up in Nashville. And she's not anti Fannie Mae and Freddie Mac as Director Calabria was. She's very friendly to the industry. So I think this isn't a foretelling of things to come. I agree with you. I think we'll see some changes in the future, and some of them will be good, and some of them will be bad. And Fannie Mae and Freddie Mac are in a very good position to analyze 70 or 80% of the industry's originations. I mean, they go through Fannie Mae and Freddie Mac. And so for the FHFA to come in and tweak some things, I certainly wouldn't be surprised if that continues.
This morning, another confusing jobs report. President Biden hailing first-time unemployment rate drops below 4%. It's at 3.9%. That's a pandemic era. I hate that term, but now we have a pandemic era low and approaching the 50-year low of 3.5% that we saw in Feb 2020, just before the pandemic. But the headline number, the Labor Department non-farm payroll number, expecting 422,000 new jobs to be added to the economy in December. The number was just 199,000, which ironically matches the number of new COVID cases in the United Wholesale headquarters.
Oh boy. Oh boy.
But another confusing jobs report. The household survey indicated strong job growth. They revised up November. So it seems like there's got to be a better way to analyze new jobs created monthly. It seems like they're still using the same system that they've used forever. And, I think that the labor secretary, Marty Walsh, something maybe he should be taking a look at, because even he made a comment this morning about, this confusing, convoluted, this is really good news. And, needing to look deeper inside the numbers, but I don't know if there's an easier way to do that. I'm not smart enough to figure that out, but we keep getting these massive, massive revisions to months prior and mismatches between the unemployment rate direction and the general momentum of the new jobs numbers that we're getting. But so all in all, it seemed like kind of a good number. I don't know. The headline number missed, but all the other stuff seemed to be good.
Mark asks if Dr. Fauci is reporting the jobs numbers. Once again, Rich, I agree with you here. The fact of the matter is, if you put a statistic out there, statistics are so crazy, and we live with statistics every day, and our industry is filled with them, and the government is filled with them. And let's say I jump a foot. I broad jump. Remember broad jump from school? I broad jump a foot, and tomorrow I broad jump 2 feet. Well, the headline reads, Chrisman doubles his leap, or Chrisman doubles whatever. Chrisman sees 100% gain in his leaping ability. Well, we know that that's not really the case, but that's what tends to show up in the headlines. When you talk about the pandemic and Omicron and COVID, don't get me started on that, but I think a lot of the press is out there to grab the headlines. And yeah, it's a serious topic, but really, I remember right after Thanksgiving when this thing popped up in South Africa, and you would have thought the world was coming to an end. Turns out it is, it is contagious, but it's not as fatal as the initial press reports would have happened. Same thing with jobless claims, same things with unemployment. I know that a couple of my favorite restaurants don't serve lunch anymore because they can't get the staff. I know that it takes a long time to get a meal, to get a dinner, or get a drink in a bar. Not that I drink in bars, but I've heard that staffing, especially in the hospitality business, is still way down. There have been incentives that the government put in place during the pandemic to, I won't say encourage people not to work, but to assist those who aren't working. And to some extent, those people aren't coming back. We have the big quit that everybody's talking about. All these people who are quitting their jobs to move elsewhere, or because they don't like their boss, or whatever it might be. They don't, they want a promotion, they're not getting it. I don't know. A lot of people are quitting for whatever reason. And you have these job statistics that say, wow, look at the great headline unemployment rate. Unemployment rate. Wow, things are really healthy. Well, they're not healthy because, you have this shrinking labor force. You have people in their 70s, 60s, 70s, 80s who are getting out of the job market entirely. They don't want to work. But you also have people that are, in theory, in the job market and they don't want a job. So how do you report that? And what implication does that have? And I think to your point, the government statistics have a hard time measuring a lot of these incidences of people not working. Why aren't they working? Are they not working because they can't get a job? Well, that's not the case. Are they not working because they don't want to work? Well, if that's the case, then should they really be part of the unemployment rate? So it's very much a situation where every individual has a different story. You have people who were gainfully employed until a year or two or three ago, and then lost their job, and they expect this kind of job at this kind of pay, and they can't get it. They are being offered this kind of job at this kind of pay, and they say, well, if that's the case, I don't want the job. I'm just going to sit here and collect unemployment, or when my unemployment runs out, I've saved up some money and I'm just going to live off of that, or I'm going to eventually sell my house and collect the equity. I mean, there's all kinds of individual stories that are going on in these huge numbers that that the government gives us. And along those lines, people will write to me occasionally and talk about China and the GDP numbers that coming out of China, or the unemployment coming out of China, or India. I mean, how do you, when you have billions of people like that, it just gets worse. The U.S. is pretty good, I would say, around the world in reporting statistics and accurate statistics, but it's still rife with problems. And the headline, the presidents, whether it's this administration or the Trump administration or Bush or Barack Obama or whoever, every president will pick, will talk about the statistic that highlights their, point the best, and the critics will highlight some other point, and, life goes on. So I think what a lot of economists who I talk to do is kind of look at the trend. They say, yeah, we have problems with these numbers. We're going to have problems every month. Who is counted? Who is not? Somebody who's not working, why aren't they working? Are they even included in the survey? I don't, hopefully if there are any government officials listening, don't call me, but I've never been asked if I have a job or if I'm looking for a job. So who do they get? So I think what economists tend to do is look at the trends and what the trends tell them, and then slice and dice after that. I think we all saw reports out of different, Fannie Mae's economists and Freddie Mac's economists and the MBA's economists this morning, and other private sector economists, just about the jobs number. And I'll finish with this. I mentioned in my commentary, I think the path of the Fed is pretty well determined. I think the Fed is going to taper their asset purchases, at some point, whether it's next month or 2 months from now or 3 months from now. And then they're going to start to tighten, meaning they're going to start to raise short-term rates, the discount rate or the overnight Fed funds rate. And that's pretty much set in motion. So we're going to get some noise from unemployment data, from GDP, from personal income and consumption, and the press will make a big deal out of those numbers. But I think the path that the Fed is on is pretty well set. And we'll see some bumps along the way. But I think overall, we know that the trend is toward higher rates.
This is The Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman. And yeah, we self-driving cars and 3D printers building homes, and we can't figure out how many jobs are being created each month. Maybe they should put the people that make the self-driving cars on the task. But yeah, so what you touched on, the Fed and tapering, and we saw rates jump up, 30-year fixed rates, 3.25-ish, highest they've been in 20 months since just after the pandemic started, really fueled largely by the release of the Fed minutes earlier this week, and those indicating discussions amongst Fed members about, not only tapering and maybe a slightly more aggressive pace than they had laid out, but also unloading some of the bonds that they have on the balance sheet and thinning out the balance sheet, and clearly fixed income stuff and the stock market. These weird scenarios in the pandemic here where typically fixed income and equities, trade opposite of one another. But once again, both kind of tanked on that news. But, as you said, I think the Fed has clearly charted out their path, and it seems like the most sane path going forward. But, one of the byproducts of that could be, we have MBAs always kind of bearish on their projections, just because it's not in their best interest to be super bullish on their projections, but predicting 30-year fixed rates in the 4s. You and I talked to Ivy Zellman, who we both respect a lot, and her thoughts on what that would do to housing. So I think it's got, mortgage lenders already heading into an uncertain year that even the rosiest projections are predicting 30% drop off. A little on edge as we head into the heart of winter.
Yeah, we are truly in a cyclical business, and lenders and vendors alike tend to see this. And I've made the point in my commentary that as a manager, it's much more fun to be expanding and hiring than contracting and potentially laying off or firing employees. I don't know what the politically correct term is, a RIF, reduction in force, whatever you want to call it. The managers out there, they've cut overtime. There's no overtime that I hear about. The employees who leave aren't being replaced. So now some hard choices are coming up, and a lot of the companies out there say, well, we'll just increase our market share. That's what we're going to do. But of course, not everybody can increase their market share. The question is your cost to produce a loan less than your competitors? Do you offer a good work environment, whether it's in the office or remote, a better work environment than your competitors? And do you have the products that your competitors might not have? So what I've seen, Rich, is a lot of lenders out there dusting off their R manuals, dusting off their down payment assistance program manuals, dusting off whatever. I guess nobody dusts anything off. I remember when I first got in this business, Rich, probably before you were born, you go into somebody's office and they'd have the GMAC manual and the RFC manual and the Bear Stearns manual and all the manuals all on their bookshelves. And the more manuals they had, the more impressed you were, or the more impressed they wanted you to be. Now, I guess there aren't those underwriting manuals anymore, but lenders are out there looking at cash out refi programs, sharpening their pencils on those. So a lot of people who were able to better their rate, better their term, have done that. So now there's a lot of equity out there. So what do we have to offer these guys and gals in terms of cash out refis, HELOCs, seconds, and so forth? So I think we'll see the product shift, but I think volumes are going to be down. I don't think anybody out there is saying, yippee, volume is going to be up for the industry. It's yippee, volume is going to be up for us, because we're hiring branches, we're hiring loan officers, we are paying signing bonuses, whatever it might be. And so there's some of that going on out there. But yeah, volumes are going to be down. Things are going to get tough.
Yeah, we conduct every 6 months a very comprehensive survey of it's about 800 key decision makers at our 260 lender members, essentially taking their pulse on the 40 to 50 most pertinent issues in the mortgage industry and what criticality they view those issues. And it's such an awesome exercise, obviously for me and our team, to be able to craft the agendas for our events and understand, what is top of mind for lenders and how to be relevant. But it's really interesting to see the changes in those surveys every 6 months. And you touched on products like, we always ask, how interested are you non-QM and construction lending and, other types of non-conforming loans, rehabilitation loans. And, almost, a year ago, like zero, everybody was in the midst of just refi madness. 6 months ago, barely on the radar. This survey shot up. I mean, big time. Automation of tasks was, I think, the biggest jump up. Now that lenders have a chance to kind of catch their breath, all of them are overstaffed to some degree. The tech that we saw proliferate on the front end, the borrower facing tech, the point of sales, the mobile stuff that started to get good 3 or 4 years ago. Now the back end tech, dehumanize the mortgage manufacturing process tech is starting to get better. So it's really what lenders, some of the trends we saw in that survey, just as it relates to what lenders are thinking about right now. So, it'll be interesting to get back in person too at the IMB.
Hang on, I'm getting a call.
Uh-oh.
Yeah. All right, I will. They wanted me to tell you that Christmas is over And I don't. I think these people need to contact you directly.
Listen, you try getting through a Cleveland winter. You need to trick yourself any way you can. It's like 3 degrees here today, so
Maybe you need some snowshoes.
something. I don't know. So but yeah. So
Are you in Nashville, by the way?
yeah, I'm going to Nashville, IMB later this month. So
Me too.
hopefully it is not too affected by all this craziness going on. I sent out some emails to some members and some lenders to get together, and just definitely got back some. I'm not going anymore, but not a huge number. So hopefully it's a good turnout, and always good to see people in person, especially after these last couple of years. So
I know that I was in touch with Marcia Davies earlier this week, and she said, yeah, we're going ahead with it, and registrations are solid. I don't know, obviously they'll have some people back out, but I think over 700 were registered last time I looked. So, I think it'll be a solid conference, and I'm looking forward to it. It's kind of a nice little conference where there's not a lot of alternative things to do with your time. I think the sessions are well attended, and I think people are there to learn, and it's kind of the kicking off the year. And I think it'll be good.
yeah, by far the best content of, in my opinion, any of the MBA conferences. And yeah, you're right. The rooms are more filled with people at the sessions. And I always leave that conference with a lot of great ideas and, feel better connected to what's going through the minds of mortgage lenders, more so than any of the MBA conferences for sure. So hopefully it'll be well attended, and hopefully we'll see a lot of you in Nashville in a few weeks. So
I had a question about the Amy popped up a note saying early bird registrations ends on January 15th for the mortgage collaboratives Fiesta Grande at the Fountain Blue, which obviously was a big hit in the 1950s, but I hear they've renovated. It's nice. Are you seeing a lot of interest in that?
yeah, oh my God, I couldn't believe Terrania, our event in September. We had 400 people, and the Delta hit like at the worst possible time. It was like 55 days before the conference. So I think our conferences are viewed a little bit different because they are more, we're doing it at nicer place. It's not as much of a, it's a little bit more spread out. And so, but our registration is far above where it's ever been this far out. So
I'm looking forward to that. I was in the gym this morning. I try to do 500 push-ups a day, and I was in the gym working out, and the attendee or the clerk or front desk person came and said, "You need to put your mask on." And I said, "Okay." I put my mask on, and I was leaving. I asked her, gee, are you getting a lot of pushback on that? And she said, "I so hate this. People are so done with the pandemic. I get yelled at because I tell people to put masks on." I said, "Yeah, like flight attendants, people are, they get yelled at all the time for these masks." But I think to your point, once again, I think people, I won't say they're over this pandemic, but it's like, holy smokes, how long is this going to go on? And I think Nashville will go on, and I have lots of speaking engagements lined up in the coming months, and I think people are going to go ahead with it. And I think people are going to exercise caution. I know the MBA's put some things in place in terms of health care guards, vaccinated or have a negative test or whatever it might be. But like we saw toward the end of last year, I mean, people genuinely want to get together with each other. And I think you'll see that at the TMC event in Florida in March. Same thing. People want to see each other.
absolutely. And going back to the jobs report, one of the look inside the numbers, very optimistic elements of that to me was the new hospitality and leisure jobs number. It was like 53,000 new ones in. It was way ahead of where they thought it would be. So more evidence people are going out, and not being prisoners of their homes, and realizing that the pandemic is what it is and still here to some degree, but go ahead and live life. So actually, we just got some breaking news. Amy B, our fabulous education and events coordinator, Sandy T, our girl, Sandra Thompson, just agreed to keynote in person in Miami at TMC Days Miami Night. So we'll have Sandra Thompson in person keynoting Monday morning there, which is great news. She keynoted virtually at Terranea. It was kind of a last second thing, but did a great job. And it was a good address. It clearly showed she had a handle on the most important issues and that she wants to listen to mortgage bankers. You know, unlike Darth Calabria, I mean, a whole different mindset from Sandy T.
She is, like I said, I met her in San Diego. She's very friendly to the industry. She does have a regulatory background. I think she's very prudent and she's not going to jump to conclusions. But yeah, I think that she values home ownership, and she's certainly not anti Fannie Mae and Freddie Mac like Director Calabria was. So yeah, I think we've got a friend there, and that's pretty cool. And I encourage everybody to say hi to her in March when she speaks. She seems friendly, like she likes people. I remember, as a quick aside, I know we're out of time here, but I went backstage one time. I was doing something backstage at a big MBA event, and there was Richard Cordray. And I started to go over just to shake his hand, say hi. And a security person stopped me, said, "No, I'm sorry, Director Calabria doesn't want, guests or visitors or anybody to." And I'm like, oh, okay. So I walked away. Totally different situation with Sandra. Very friendly, very, very much a friend of the industry.
Yeah, absolutely. So, and the link to register for our Miami conference in March is linked in the chat. The early bird pricing is open for another 8 days. And yeah, going to be a fabulous event at the iconic Fontainebleau Hotel in South Beach in Miami. And
time flies, Rich. Time flies. I mean, wasn't it just Halloween? Wasn't it just Thanksgiving? I mean, we're already, you say, out in March. Well, March is only a couple months away. I mean, Halloween was a couple months ago.
Yeah.
Time goes fast.
Yeah, 10 weeks away, as Amy notes in the chat. And also linked in the chat is I just released my bold predictions column for 2022. Everybody's sick of hearing the same stale, boring predictions. So I tried to have a little fun with it, and we'll see if any of those come true. Hopefully none of those come true.
Yeah, I think the industry was waiting for those projections. So
exactly, with bated breath. Yeah. So, Rob, any last notes of wisdom to take our loyal listeners into the weekend with?
Well, is college football season over with, Rich? You didn't bring. I guess we didn't have a co-host for you to talk college football with, and I'm a sports idiot when it comes to that.
The national championship game is this weekend coming up, and yeah, it's 2 SEC teams. I'll certainly watch the game.
This weekend?
Yeah, Alabama and Georgia. So Georgia laid waste to Michigan, if Chris Bennett's listening. But
what day do they play?
They play. It's on Monday night, actually. Not this.
Oh, Monday. All right.
Yeah.
Is that for TV ratings?
Yeah, they don't want to compete with the NFL, who does Saturday night games, a couple Saturday games now, and Sundays last week of the regular season. So, yeah, so big football weekend, and I see some Georgia and Bama smack coming into the chat box. So, but it should be a good game. It's the 2 best teams. That's what you want to see, and it should be good. So,
all right.
Excellent. Well, once again, thank you, Rob. Good seeing you as always. Happy New Year. And to our viewers and listeners, I know a lot of you, most of you listen on podcast. I want to thank you for making us part of your week. We'll continue to do this every Friday at 3 p.m. Eastern and try to take you into the weekend each week with a lighthearted recap of the week that was in the mortgage industry. And it's always ways to get involved in the show. If you want to be part of the show, let myself or Rob know, and happy to do that. Got some great co-hosts coming up, and we do the rundown live at our conference, which we'll do in Miami during the Tuesday lunch. Had a lot of fun with that at our last event in California. So another fun year for the rundown. And Rob, always enjoy talking through the business with you.
And likewise, thank you for having me.
Excellent. And until next week, have a great weekend, everyone. And we'll see you next Friday. Take care.